Hello, my dear investor. I present you 3 stocks on discount, 3 dividend stock on discount for you to get more dividends for your bucks. My name is Thorsten Tiet. I'm the founder of Dividend-Stocks Cash. We have more than 100,000 members already on this beautiful website. And little disclaimer, no buy, sell recommendation. You're responsible for your own money. And now, good entertainment. As you might know, we cover stocks from all over the world. I show you the first one is Ping An Insurance. It's from China. And Ping An shines with a dividend yield of more than 8%, 8.1%. And you can see here in the dividend turbo that dividends are really outstandingly high with 8.1%, and they should reach 10% based on current stock price at the beginning of 2027. Chinese stocks are not for everybody, just for courageous people and believers. And I think this could be interesting because life insurance especially is a good and still booming business in China thanks to growing wealth of population and aging population. But there were some headwinds currently. First, Corona in 22. You remember zero COVID strategy probably. And we also have a sluggish economy a little bit right now in China. And we have this tech crunch or increasing regulation right now. Many of these insurance companies, especially Ping An, they acquired or they have stakes in tech companies, and due to this regulation, these stakes go down in value. We also have problems in the real estate market in China. Ping An also invests in real estate, but only around 5% of their complete investments are invested in real estate. Other investments are, for example, in the stock market. And the Chinese stock market, unfortunately, is also a little bit in decline right now, which means that after Ping An presented their results for 23, it was a little disappointment and the stock price dropped once again. You can see it here. Stock price dropped around 6% after announcement of the results. And results were not bad regarding the core business. For example, the new contracts in life insurance business grew for about 36% in 23 compared to 22, 36%. What was also thanks to a more efficient sales structure. But unfortunately, the earnings were still below estimates. Earnings were 86 billion yuan, but it was less than estimated because there was a loss of 21 billion yuan in their investments. And that hurt. But from this headwind can become tailwind when the stock market, for example, goes up again, and this could boost the stock price, and then this could result today in a nice buying opportunity. And if we look into the quality check, we see also nice evolutions. For example, here regarding the balance sheet, you see here that the total interest-bearing debt of Ping An was really heavily reduced and the cash went up. So Ping An is basically debt-free, and you see that the debt ratio is below 10% and that cash exceeds interest-bearing debt. So this is a very good sign. What I also need to mention is that although investments in real estate are only about 5%, it's a little bit risky and it's a little bit opaque because Ping An is working with joint ventures as minority partner. It means they have up to 49% or below 50% stake in the joint venture, and then they give loans for these joint ventures, and these joint ventures are there to invest in real estate. This makes it a little bit more opaque, so intransparent. So there might be some surprises yet to come, hopefully not. So there is some risk. This is probably why the stocks trades so low. We have multiples here which are really low. Let's go to the fair value immediately. As you can see, price earnings based on adjusted earnings is 5.2, based on reported earnings 5.9, which is really low. We have two valuations now. We have a light version and the professional version. We stick to the light version for this. And you can see here the fair value based on consensus estimates. This is this line here, and then you have here these extremes. These are the analysts who are more optimistic or pessimistic, and we calculate 3 fair values here for each time. And when you just look like this, you get, even based on the consensus for 25 business year, you have an annual expected yield of 74%, which is a little bit high. We can add or put all the risk in by bringing the price earnings to calculate the fair value down to 6, which is around the price earnings of today, and then we still have an expected annual yield of close to 30% based on negative estimate for 25 with price earnings of 6 used for fair value calculation. So you see there is an elevated risk, but there's also elevated chance of high returns. So this is Ping An, the first dividend stock on discount. The second one is a much more traditional stock. It's Starbucks. Of course, you know, they also have a China business. They make some of their revenue in China. You can see it here in the region tab. It's about close to 9% of sales are done in China. But I think the main reasons or important other reasons, other than a little bit sluggish demand and risk in China, is a social media boycott because of it was called pro-Palestinian tweet on X from Starbucks, and we have this dispute, this traditional, for a long time already ongoing dispute with trade unions, Starbucks versus trade unions, but which is coming to an end. And I think because Howard Schultz, the former CEO, left once for all, most probably Starbucks, and now they try to make peace with Starbucks management, with the trade union, and they already pay not bad. So I think there will be not a high financial burden for Starbucks if it gets unionized. And this tweet shit and this shitstorms related to this of some people who think they need to be woke or whatever, I don't think that it will last a long time. Starbucks will outdo this, survive, and then hopefully the performance of the stock will be better again. We have overall, if you look back a long time, you see nice performance, but performance becomes lackluster if you compare 2019, mid of 2019 to now. So could be a nice buying opportunity because earnings all this time were growing. You see it nicely here. Also operating cash flow is growing, and of course dividends also growing. Dividends now at 2.5%, close to 2.5%, and expected to grow and grow and grow. And October 27, based on current stock price, should be 3.8% low. Let's check the fair value. And then we have here clear undervaluation of Starbucks, but we can bring the fair value down. And let's use the pro version, so you see maybe the difference. Now it's based on adjusted earnings. I zoom in a little, and here you see the fair value of the past, and then now here we have expected annual yield of more than 23%. Wow, for the next years till 27 September. It's based on a price earnings of 28. Is it still justified? If you look at the estimated growth, then you can see here estimated earnings growth of around 15%. I would say it's not too much, because in the past earnings growth was like that as well, and the stock was that high estimated. Just a little bit that here price earnings went down artificially, but we detected an outlier here, so it's not used for the average calculation of the price earnings. So we can go with this. If you want to make it a little bit more conservative, you can lower the price earnings used to calculate the fair value maybe to 25 around current valuation, and then you still have here estimated yield of 19%. So I can't otherwise but say this is a nice buying opportunity. Okay, it was the second stock. The third stock is a stock you have never heard before, except you watch this video in Australia or New Zealand, because I'm now talking about the ABOS Group, drug retail merchant, one of the biggest merchants for pharmacy and medical stuff, and also a little bit for pet and animals, animal food, I believe, mostly, but this is a very small segment. You can see it here. Most is done in the healthcare segment with nice margins. And we have currently, where is it? It's in a dividend turbo, of course. Current dividend yield is 2.8%, which is much more than in the past, where it was about 2.2%. And of course, this is because the performance and the last time was lackluster. We have here New Zealand dollars 46.50, and now current stock price is 35.60. So went down, but in the long run, it was a good investment, not that bad at least, with around 1,200% capital gains, including some dividends since 2000. So what happened is they are going to lose major customer responsible for around 16% of total revenue. And what that means, we can see it here. Revenue will go down, earnings will go down a little. You see, but you see here that it's really cash flow giant, this company. Their free cash flow, let's see, no, their free cash flow is less than their earnings a little bit, but it still covers dividends and expected to grow, and in the future it's expected that dividends are still covered and not cut. But we have here lower revenues because we lost this major customer. The customer, on the other hand, does not want to leave business with ABOS Group, because ABOS Group does bad business, but the customer is called Chemist Warehouse, and they are going to merge with Sigma Healthcare, and Sigma Healthcare is a competitor of ABOS Group. So this might be, I think, the reason why they want to do business anymore with ABOS Group. So this could be a nice buying opportunity. Maybe, let's check, this sell-off here could be nice buying opportunity. At least we have here, let's check, for 1 year, 22% capital losses, a little bit more because we have here already 2 dividends factored in. And if you look at the fair value, we also use here, we also use the Pro version. And then you can see here that based on the estimates, we have still a slight overvaluation, unfortunately, of the stock. Why did I show you the stock anyway? Because I think it's a quality stock, business model is fine, and it might come down. The dividends are already elevated, and here you could set a buy limit, for example, 32 New Zealand dollar, and then you already have an expected yield of 6.4%. If you want make it on around 30 New Zealand dollar expected yield will already be around 11%. And I think such a stock can also be interesting. And this is why I wanted to present this to you. Okay, so I showed you 3 completely different stocks with Starbucks, Ping An, and now this EOS Group. Feel free to drop me a comment. Which of these stock is your favorite, or maybe you have an own dividend stock on discount discovered, then you can also drop a comment below. Happy to discuss. Thanks for watching this video and see you next time. Bye bye.